This week's market update. Central banks continue to send out mixed messages. Recession fears increase as bond yields raise a warning flag. Oil falls on oversupply fears. And the door is open slightly for China to join the global stock market club. Another week and yet more mixed messages from the world's central banks. The differences between and within central banks emerged as a major talking point this week as markets try to determine where next for monetary policy. 10 days ago, the Fed, as expected, raised rates by another quarter point, while also setting out a roadmap for unwinding its $4.5 trillion balance sheet. Meanwhile, on this side of the pond, the Bank of England left rates at their 300-year low of 0.25%, despite 3 dissenting voices on the 8-strong Monetary Policy Committee. Then last week, Mark Carney set out to justify his continuing dovishness on interest rates. He explained in his annual Mansion House speech that now is not the time to raise interest rates. But less than 24 hours later, the bank's chief economist, Andy Haldane, seemed to take the opposite position. The challenge for the bank is knowing how to deal with above-target inflation when the underlying cause of the overshoot is simply a plunging currency and not an overheating economy. Given that the gap between sterling-fueled inflation and stagnant household earnings is actually a deflationary combination, Mr. Carney's instinct is to maintain an accommodative monetary policy. It appears, however, that he's finding it harder to bring all his colleagues with him. Over in the US, meanwhile, the division is between the Fed's view of the world and the financial markets. Although the central bank is determined to stick to its tightening path, heading for 3% interest rates within a couple of years and beginning to unwind its bloated balance sheet, markets are unconvinced that this is how things will pan out. The so-called yield curve is a measure of the market's expectations about interest rates and inflation. If short-term rates are low, but expectations are for rising inflation in years to come, then on a chart the curve will be upwards from left to right. In other words, long rates will be higher than short rates. If, on the other hand, short-term rates are rising because interest rates are on their way up, but longer-term inflation expectations are low because investors fear recession, then the curve will be flatter. In extreme cases, it will be downwards or inverted because long rates are lower than short rates. Well, recently, the yield curve has indeed been flattening. And because this measure has a very good track record of predicting future recessions, investors have started to worry that maybe the bond market knows more than they do. They're concerned that the equity market, close to all-time highs, may be looking at the world through rose-tinted glasses, while the gloomy bond market may have got it right. This dilemma explains why flows into equity funds last week were pretty tepid. Having reached nearly $25 billion in the second week of June, they failed to reach $1 billion last week. As well as concerns about the level of central bank support, investors are worried about valuations in the US, where stocks are relatively highly rated. Inflows into other equity markets around the world actually picked up the slack, with Asia and Europe in favour. Emerging markets had a 14th straight week of inflows. This rotation provides an interesting backdrop to my quarterly investment outlook, which I'm working on this week. As usual, I'll present this via an online question and answer session next Tuesday at 7 p.m. So watch out for details on our website, fidelity.co.uk. As usual, I'll provide an overview of all the main asset classes and geographical regions, as well as providing commentary on the main market moving events at the moment. Well, one of these, and the main equity market story of last week, was the decision by index provider MSCI to include Chinese A-shares in its global indices, including the widely followed Emerging Markets Index. MSCI has been considering this move for some years, but it held off until this week amid fears that China's domestic markets were too volatile, poorly regulated and illiquid for inclusion in an index, which many tracker funds will follow. Putting A-shares into the index means many index funds will now be obliged to buy A-shares to ensure they can mimic the index's performance. To be clear, MSCI's move is fairly tentative. It's only including 222 Chinese companies to start with out of more than 3,000 quoted A-shares. And it will only include 5% of their market value in its calculations. That means A shares will only account for less than 1% of the MSCI Emerging Market Index, despite China being the world's second largest stock market after the US. This is not quite the whole story, because Chinese companies quoted in Hong Kong and New York already account for around a quarter of the index. But it does mean we're still some way off China really gaining full-fledged membership of the global markets club. One interesting aspect of this story is the extent to which index tracking funds are in fact a product of allocation decisions made by the index providers, rather than what most people think a real measure of underlying markets. It's not clear how well understood that was before last week's announcement. MSCI's caution seemed to be vindicated just the day after its announcement, when China's banking regulator said it was assessing banks' exposure to 5 big companies, including some of the most aggressive overseas investors. China's central bank has been trying all year to discourage risky borrowing by tightening lending criteria, and the latest move appears to confirm widely held views that China is in the grips of a dangerous credit bubble. Definitely not in bubble territory at the moment is the oil price, which has suffered another volatile week as oversupply fears have questioned the influence over the crude price of OPEC. The oil cartel announced production curbs last November and extended them recently until next year in a bid to underpin the oil price. Unfortunately for the Saudi-led group, new sources of supply have plugged the gap and then some. First, Libya and Nigeria, which were given a free pass when the curbs were announced due to their internal security issues and their need for oil revenues, have both increased production. In addition, the US shale industry has been pumping fast, with a further 250 rigs coming on stream this year. That's a 50% increase. The net result of all this new supply has been a fall in the price of Brent to as low as $45 a barrel. That's safely above the low reached early last year, below $30, but it does suggest that OPEC's dream of a price above $60 a barrel may not be achieved anytime soon. All that remains to be seen is how long the cartel can maintain its discipline in the face of a persistently low price and a fall in associated revenues. Meanwhile, the shadow cast by the financial crisis continues to lengthen as Italy moved to liquidate 2 of its stricken regional banks. That stirred up a huge euro row in the process. At issue is 17 billion euros of taxpayers' money, some of which the Italian government has earmarked to bail out senior bondholders in the 2 banks. Junior bonds and the bank shares have been wiped out, but questions have been raised about whether Italy has broken European state aid rules by using public money to support some of its investors and bypass a so-called resolution process. The resolution rules were introduced after the financial crisis to ensure that taxpayers should not find themselves on the hook for rescuing failing banks. And many in Europe, notably the Germans, are furious that Italy has apparently found a loophole to avoid the process. And finally, the weekly Brexit update. After nearly 3 weeks of hard negotiating, the UK government has finally secured a deal. Not a Brexit deal, of course. That will take another 2 or maybe 10 years, depending on who you listen to. This week's deal was just to get the Conservative Party over the line for a parliamentary majority, so it can get through Thursday's vote on the Queen's speech and stand a chance of pushing through all the Brexit-related legislation still to come. Securing the support of the DUP is understood to have cost £1 billion in new spending promises in Northern Ireland. That's a deal which amounts to £100 million for each of 10 MPs' votes, and it is certain to be the cause of deep resentment in Scotland and Wales. But for the time being, it keeps the government in the driving seat and delays the next election, for which I suppose we should all be truly grateful. Meanwhile, in Brussels, Theresa May has made an initial offer on the status of EU citizens resident in the UK and had it promptly pushed back by her EU negotiating partners. And so it begins.